If you've been shopping lately, you've probably noticed something subtle but important. The discounts aren't what they used to be. Fewer big sales, smaller markdowns, shorter promotions, and in some cases, no discounts at all. For years, discounts were everywhere. Seasonal sales, clearance events, flash deals. Companies trained customers to expect lower prices if they just waited long enough. But now that entire strategy is starting to fade, and the reason why goes much deeper than just pricing. Because what's really happening is a fundamental shift in how businesses make money. This is why discounts are disappearing across America. To understand this, you have to start with margins. For a long time, companies could afford to discount heavily. Costs were relatively stable, supply chains were efficient, and businesses could make up for lower prices with higher volume. Sell more units, even at a discount, and you could still come out ahead. But that equation has changed. Today, costs are rising across the board: materials, labor, transportation, energy. At the same time, supply chains are more complex and less predictable. That leaves companies with less room to cut prices without hurting their bottom line. Discounting isn't just a marketing tactic anymore, it's a direct hit to profitability, and many businesses simply can't afford it. So instead of using discounts to drive sales, companies are protecting their margins, and that means fewer deals. Another major reason discounts are disappearing is because companies are rethinking customer behavior. For years, heavy discounting trained customers to wait. Why buy something today if it's going to be cheaper next week? This created a cycle where businesses had to keep offering promotions just to maintain demand. But that strategy comes with a cost. It erodes brand value, it reduces pricing power, and it attracts price-sensitive customers who may not be loyal. Now, companies are trying to break that cycle. They're pulling back on discounts to retrain customers, to shift expectations away from constant deals and toward consistent pricing. It's not easy, but it's happening. Another big factor is the rise of data-driven pricing. Businesses now have far more insight into customer behavior than ever before. They know when people are most likely to buy, what they're willing to pay, and how demand changes over time. This allows companies to be much more precise. Instead of offering broad, blanket discounts, they can adjust prices strategically. They can offer targeted promotions to specific customers or optimize pricing in real time based on demand. In other words, they don't need big public discounts anymore. They can achieve the same or better results with smarter pricing. There's also a shift in product strategy. Companies are focusing more on value than volume. Instead of pushing as many units as possible through discounts, they're trying to increase the value of each sale. That might mean offering higher quality products, bundling services, or creating premium versions. When customers perceive more value, they're less sensitive to price, and that reduces the need for discounts. This ties into brand positioning as well. Strong brands don't rely heavily on discounts. They rely on trust, quality, and customer loyalty. If a customer believes a product is worth the price, they're more likely to buy it without waiting for a sale. That's why many companies are investing heavily in branding, customer experience, and product differentiation. They're trying to move away from competing on price and toward competing on value, and that's a big shift. Another important factor is inventory. In the past, discounts were often used to clear excess stock. If companies overproduced or demand slowed down, sales and markdowns were a quick way to move inventory. But today, inventory management has improved. Companies are using data to better predict demand, optimize production, and manage stock levels more efficiently. This reduces the need for large clearance events. Simply put, businesses are getting better at not overproducing in the first place. And if you don't have excess inventory, you don't need to discount it. There's also a broader economic shift happening. Consumers are becoming more selective about what they buy. They're prioritizing essentials, cutting back on impulse purchases, and focusing on value. This might sound like it would lead to more discounts, but in reality, it's doing the opposite. Because when demand becomes less predictable, companies become more cautious. They're less willing to lower prices aggressively if they're unsure how the market will respond. Instead, they focus on maintaining stable pricing and protecting margins. It's a more defensive strategy. And then there's the role of inflation. Even as inflation slows down in some areas, prices have already moved higher. Companies are reluctant to bring prices back down, especially if their costs remain elevated. Discounting would effectively reverse those price increases, and many businesses aren't willing to do that unless absolutely necessary. So instead of lowering prices, they're holding the line, and that means fewer visible discounts. But here's something interesting. Discounts aren't disappearing completely, they're just becoming less obvious. Instead of big public sales, companies are shifting toward more subtle tactics: personalized offers, loyalty rewards, bundled deals, limited-time perks. These strategies allow businesses to offer value without broadly lowering prices. It's a more controlled approach, and it's often more profitable. So what does all of this mean? It means the era of constant discounting is fading. Not because companies don't want to attract customers, but because the economics no longer support it. Margins are tighter, costs are higher, and businesses are becoming more disciplined about how they price their products. Instead of relying on discounts to drive demand, they're focusing on value, efficiency, and strategy. And for consumers, that represents a shift. Waiting for the next big sale might not work the way it used to, because in today's market, the price you see is increasingly the price you get. And for businesses, that's exactly the point. Because the less they rely on discounts, the more control they have over their profits. And in an uncertain economy, control is everything.